Hello. As should be self-evident by my presence on this tape, I can't be with you here today. Unless something's gone awry, as you'll hear me, I'll be just finishing up on my roundtable discussion on regulation and reporting at the Private Equity Leadership Summit of the Asian Venture Capital Journal Conference in Hong Kong, courtesy of sponsorship by Guernsey Finance. I'll be on my way home this week, as I've just spent a month in Hong Kong staffing our regulatory representative office. And while I've been here, amongst other things, I've been undertaking various activities designed to position and promote our regulatory presence out here. And we've taken the liberty of gently introducing the market out here to the Private Investment Fund by way of drawing attention to our live consultation. My presence on the AVCJ panel today hopefully helped me position Guernsey's regulated environment as one that is safe and secure for the Asian investor. But I digress a little. The purpose of this recorded slot is to talk Financial Stability 2016. I'm sure my colleagues will have covered the many international affairs that I've been working on throughout the course of the last year. 12 months ago, for example, I was out seconded in Brussels, working on behalf of both Channel Islands governments and regulators on the European Union's Capital Markets Union and the Channel Islands strategy and approach to that. Shows what a difference a year can make. It's been quite the hostage to fortune to do a pre-record on the subject of financial stability. It's bad enough doing an internal quarterly report, which I have to submit 10 days ahead of the deadline. So I'll probably focus on giving an update on more process matters. Throughout 2016, in my opinion, the key primary source of global risk have been the low interest rates and the excessive debt environment. Twin forces leading to a continual chasing of the dragon in the search for yield and leading to massive asset misallocation. This has been my view for quite a while. Some of you may recall it for the topic of one of my columns 30 months ago in the Guernsey Press. It's also the house view of the Bank for International Settlements, where I had the pleasure earlier this year to listen to Claudio Burrio detail firsthand his views on these issues. These imbalances have led to a raft of problems across a raft of sectors and geographies throughout 2016, of which I'm sure you'll have read most. Banking problems across Europe, long-term issues of solvency in pensions and the insurance sectors, problems in the fund sectors, most recently real estate, and across the world in areas such as China and in South America. Touching on risks closer to home, while Brexit initially provided few immediate financial stability risks, it did provide a case study in liquidity mismatch, particularly in the commercial real estate class, where we saw many funds gated in the immediate aftermath of the result. In perhaps a touch of irony, IOSCO and the FSB had just prior to the referendum published new proposals and international standards to mitigate such risks globally. These proposals were in fact policymakers' alternative plans in response to systemic risks in asset management, having been rebuffed in their attempt previous year to designate certain asset managers as globally significant, in a manner similar to banking and the insurance industries. Brexit risks continue to manifest themselves, most obviously in exchange rates, and that's ongoing and we'll continue to monitor that. All that to one side, the key story from a Guernsey perspective this year is process. I was appointed as Director of Financial Stability in April, adding to my international duties, and my work programme over the course of the ensuing 12 months was producing a general risk assessment, both for external and external purposes, assessing our systemic risk monitoring procedures and processes, benchmarking them against international and other standards, and also reviewing our macroprudential framework to give consideration to what, if anything, we needed to change. For those of you with long enough memories and the ex-engineers in the room, a lot of BS 5750 of the processes. Finally, on the topic of financial stability, the State Financial Stability Committee itself met for the first time at the beginning of October, chaired by Peter Sedgwick, who has an impeccable pedigree, an ex-Treasury official, ex-board of the EIB, and knowledge of our private equity industry through his previous board membership of 3i. George Buckley, Deutsche Bank's chief UK economist, is also a member, whom I'm sure will bring a lot to the table. The committee reports its first in a year, and I'm sure that its work will be a positive contribution to the economy of the island. Finally, in terms of positive contributions to the island, I'd just like to mention the current live discussion paper on modernising our pension supervisory framework. It's something I'm personally quite vested in, I believe it's of benefit to both bailiwick consumers and bailiwick firms. And in terms of global policy issues going forward, they don't come much bigger than pensions. So making sure our framework is modernised and fit for purpose is, in my opinion, quite vital. So I hope many of you will join in the discussion. I'm happy to end there, in fact, and I'll sign off today by wishing you all a most productive session there in St James's.